So Shane, it's certainly been a crazy couple of years for borrowers and, prospective buyers with the sharp rise in interest rates we've seen. Property prices continue to rise at an alarming rate. We've had new entrants entering the mortgage market, other entrants, I suppose other operators leaving essentially. Um, Delighted to get you on today. Thanks so much for your time. We just want to kind of pick your brain, get some advice for prospective buyers and borrowers, and obviously just get a sense of where the property and mortgage market is at the moment. So thank you very much for coming on. How are you?
Well, thank you for having us on. Delighted to be here.
Great stuff. Perfect. So you're in the mortgage game a long time, Shane. I'm not trying to get you to disclose your
Too
age, but
long.
how
I'm in
long
the
you?
mortgage game 36 years.
Wow.
Done all sides of the mortgage, whether it's lender side or intermediary side. But yes, I have my fill of mortgage at this stage.
And take me through your journey, Shane. Did you initially start out with some of the big lenders and the banks, and then
I
eventually?
started out in building society land. There's no such thing as building society really anymore, but started out in Irish Permanent Building Society in the 1990, and I went through various roles in Irish Permanent, ended up in a IFG, who would have been the biggest brokerage in Ireland at the time, various different brokerages since then, and we have, I suppose, an amalgamated company, Munster Mortgage and Finance, for the last 5 years that we've been operating out of, based in the South Ballon, Cork.
Perfect. So I mentioned that the last couple of years have been pretty crazy, but like in your 36 years, would you see the last kind of 5 to 7 years as one of the most challenging periods for borrowers with the environment we find ourselves in?
I think absolutely, like in terms of ourselves, the challenging periods were really, pre-crash days of kind of '06, '07, '08,
Yeah.
just purely based on volume and the size of the market. And
Slightly before my time.
absolutely, well, lucky for you. But in terms of challenges for the consumer or the potential mortgage applicant, it's getting harder each year. And it's significantly different to when it was back then in terms of what you need to do, how you need to position yourself, and the process that the bank puts you through. Now, on saying that, that's a very prudent approach by the bank. If the banks approached it like that pre-crash days, then the crash may have been half the size of what the crash was. So never knock the prudency. It's there for a good reason as well.
Yeah, absolutely. Good point. And like people talk about the unprecedented levels of borrowings at the moment. Like what's a typical mortgage amount nowadays? If let's say I'm a first time buyer couple, how much am I typically borrowing, or what kind of loans is it?
Well, the national average for last year in 2024 was 320,000, which was a new record since records began. Now, records only began in 2011, by the way.
Okay.
Right? But that was up from 294 the previous year. I think one thing that everybody should be aware of here is, depending where you are in Ireland, that average is skewed. So, like if you're in the greater Leinster area, that 320 is going to be up towards 380. If you're more in rural Ireland, that's going to end up being a figure somewhere around 250.
I was just about to
really
say.
really depends where you are and if you're city based.
Yeah. Places like Dublin, you're going to struggle to find a property for 320,000, let alone borrowings of 320.
Absolutely, and like some of the issues that the people in Dublin particularly have, or it's not just Dublin, it's the greater Leinster area that they have, is they miss out on a lot of the government incentives as well, because the government incentives are set at a certain level. The main one being the Help to Buy, which is set at a property price level of 500,000. It's very hard to find a new property in the greater Leinster area that's less than 500,000.
Yeah, absolutely. And just for people that, let's say, are maybe kind of struggling to afford those property prices, or just finding the environment really challenging, you spoke about the Help to Buy. Is there any other kind of supports that people can avail of to help them get on the property?
There's a number of supports there, but I'd certainly say one thing to David, and that is that if somebody is struggling, to achieve a property level, they're getting a mortgage that is likely that they'll be struggling with.
Yeah.
You should never put yourself in that position. So always factor that into your thinking. But I suppose the aids or the grants that are there that are available from the state as such is the Help to Buy is the main one, which is for a new house only. Max value 500,000. You have to be borrowing 70%, and it's a tax rebate of what you've paid over the last 4 years. Okay. Right? New house only. Now, that is fantastic. It is a tax rebate, so there's a great incentive for you to get tax back that you've paid over the last 4 years. The other incentives that are there are schemes more so than incentives. So you'd have the Affordable Housing Scheme, which is a shared percentage scheme that you give with the council. There's the First Home Scheme, which is similar to the Affordable Housing Scheme. And there are a number of other grants available to you, which would be in a refurbishment or a vacant property type scenario. again, the grant side of it with the vacant property or derelict property, that is a grant. That is an incentive. Whether you'd call the affordable housing scheme or the first home scheme an incentive, that's debatable.
And are you seeing a lot of people at the moment utilising those derelict grants and stuff, buying kind of...
You would, but we would also say that you'd see that the property market reflects that in the purchase price of the house.
Yeah.
So one of the main questions everybody would ask if they're looking at a property, the first question they're asking an auctioneer is, has that been vacant for a certain period of time? In other words, does it qualify for the vacant property grant? And auctioneers being auctioneers, that would be priced into the price of the property.
Perfect. So I think the last time we were speaking, which were probably maybe a year ago now, you were saying that it was kind of like the first time ever where some of your clients were kind of saying, look, prices are getting too crazy. We're just going to maybe stay renting for now because maybe the rent that we're paying for the first time ever, it's a bit less than the mortgage repayments on what our mortgage might be. Is that still the case?
I don't think that's still the case because rates have come down in that period in the past year. But like everything we'd say to people here is like the ideal situation for anybody is that if we're renting at €2,000 a month, if you can replace that €2,000 a month with a mortgage repayment and achieve a property or get yourself on the property ladder, we think that's a nice space for anybody to be in. I suppose where the problem comes is you do have people on the fence for a whole variety of reasons, but those on the fence thinking prices are going to come down, very, very, very debatable in the current market, particularly when you've got the pure macro microeconomics of supply and demand, with demand still outstripping supply. So that's certainly that has to be factored in. But again, we'd go back and say, if you have an advantageous rental position, which is somewhere that you're significantly under the market rent, now I could see you backing away and saying, look, we'll bide our time here and we'll wait for the market conditions to be right for us. But if you're in a normal rent scenario of your average 2,000 to 2.5 on a monthly basis, I think with the current market rates on offer, you're going to find that your monthly mortgage repayment is going to be thereabouts what your rental commitment is.
Yeah, absolutely. And this kind of whole thing about people trying to time the market, because I see it all the time. Like, it always takes me back to when we bought, it was about 5 years ago, like in the peak of COVID, and everybody was saying to us, don't buy, property prices are going to plummet. And like yourself, I said, look, we have a simple supply versus demand issue here. I can't see prices going down, or at best they probably will plateau. And sure, we decided to move ahead with it. We found a house that we were happy staying with it for a couple of years. Fortunately, we could afford the mortgage, and we just went ahead with things, and lo and behold, the value of that property has gone up significantly. And if we waited, we probably would have priced ourselves out of the market, which I think a lot of people have ended up doing for themselves. So the advice now that I always give to clients is that if you can afford the mortgage and you find a property you like and you can afford and you're happy to stay there for a good couple of years, just go ahead with it, because you're risking pricing yourself out of the market. But I mean, chances are, if you stay in a house long term, you're not going to be there looking at the value in 2, 3, 5, 10 years time, because it's going to be higher, once you get to the end of your mortgage anyway, isn't it?
Well, natural price inflation is going to do that for you. So,
Yeah.
like if you look at a 3-bed semi in any part of Ireland, go back 10 years ago, what was the value? Go back 20 years ago, what was the value? And you'll come along and you'll find that natural price inflation has looked after that significantly. And that's including a crash time and a fairly long recovery crash time as well. So I think your point is well made, and your point stands up that if you can get yourself on the property ladder, you are probably looking at only property price appreciation when you take it over a significant period of time. If you're looking at the shorter term, 3 to 5 years, and think, what's my property going to be worth in 3 to 5 years, that's very different, because I just don't think you're giving yourself enough time for the economics of the property appreciation to happen.
Yeah, absolutely. So let's talk about interest rates. Obviously, we've been through a really volatile period of interest rate. People got used to, over 10 years of ultra low interest rates. They got used to their 1.1 tracker rates, their 1.95% fixed rates, and suddenly we've had a massive spike in interest rates, and now it's starting to reverse a bit. Even though interest rates have started to come back down a bit in the last couple of months, Shane, we've seen, 7 or 8 central bank cuts now in the last couple of months. Do you ever see us going back to those, ultra low rates of the Avant giving 1.95, or your tracker rates coming back down to 1%? Or do people need to appreciate that those days are gone for a long time?
That's a question for the smart guys in the room, and I'm not the smart guy in the room.
Don't look over here either.
Yeah. But if you look at interest rate, and you look at the interest rate environment, David, and you see, okay, where have we come from? Where have we historically come from? Where are we today, and where might we be in the future? So if we start with where we came from obviously the ECB having a 0% interest rate for 12 years. And for that 12 years that was there, people who had tracker mortgages were absolutely winning. That turned around in summer 22 when rates started to rise, primarily due to world dynamics of the recovery from COVID, the inflation that came out of COVID, the Ukraine, and the initial talking of Israel and Gaza and things like this. That drove rates up. That was then for the ECB to keep an eye on their inflationary rate, etc. But the big thing that we would always explain to people is that if you look at the monetary policy belonging to the EU or the ECB, they want to have their benchmark lending rate at 2%, and they'd like their inflation rate to be at 2%.
Yeah.
So let's give these guys credit, so that they will get their roles right. That means that the lending rate that was 0% will be 2%. Now you add your tracker margin onto that and you say, okay, if I have a 1% tracker margin, I will end up paying 3%. And I think the only scenario where you're going to see that ECB reduce their rates below the 2% is something is happening in the world dynamics, such as the Ukraine has continued, Israel has continued. The big one, obviously, is the tariffs and Donald Trump policies and what that does or does not do. So if we were to look forward and say to you that earlier this year, again, the smart guys in the room, in our view being the economists, would have all flagged that the current rate curve of a downward rate curve is going to last until May of 2026.
Okay.
Then they expected the rate curve to go up. But even no matter how smart these guys are, they all wave the red flag in front of your face to say, we can't call what Donald Trump policies will do to rates.
Yeah.
It may mean that the curve is extended. It may also mean that the curve is shortened. Now, to answer your question about going back to where we were in Avant Money and the rates that were on offer back in summer 22 was, I suppose the standout one for us was you could have forever money at 2.25, 2.35. And forever money being I'm fixing for the life of my mortgage at a rate of 2.35. That forever money went up to 405. It's now back down to 3.4.
Okay.
But again, talking about interest rates and for the, I suppose, the any viewers here saying, okay, I hear that the ECB reduced again or is reducing again, that's not necessarily affecting the rate that you have or the rate that you may be getting from a bank, because that's really related to still those on tracker mortgages. So if you're to look at that scenario, you'll say that the forever money, when it was cheap, which was your 195 7-year fixed or the 225, 235 forever money, that was money that was borrowed from the money market when money market money was cheap.
Yeah.
And in summer 22, those who put the cheap money into the money market got nervy and started moving to crypto, started moving to gold, and all of a sudden the money market is more expensive. Now the money market has come back of late, but it's still nowhere near where it was in 2022, and I think that was the real dynamic that drove those low interest rates.
Perfect. So knowing what we know, or more appropriately thinking what we think, we're probably sitting, what is it, about maybe average rates 3.5% at the moment. The indication is that they are going to probably keep reducing unless something else changes, probably go below 3%. So,
but not a lot.
Okay.
But not a lot. And again, if you go back and say, okay, what have interest rates been like historically, the big stat that stands out is that the average rate in Ireland over a 35-year period has been 5.3. That gives you days, obviously when rates were 2, but it also gives you days when rates were 8. I can also tell you, just purely from being around long enough, we remember rates being stuck at 10, 12, 14, 16% in the late 90s.
Yeah, and probably a good indication is if you look at the banks at the moment, they're the main lenders, they're probably trying to entice people into slightly longer rates, like the 4, 5, 7-year fixed rates are a lot higher, or sorry, they're a lot lower now than maybe the 1, 2-year fixed rates. Is it a strategy you're seeing at the moment, kind of where people are saying, look, I think rates are going to continue to rise, rather than me locking in a 3.8% rate for 5 years, I might just look at a 4% or a 4.15% variable rate now and reassess things in a year's time and hopefully fix at that time at the lowest point of the interest rate cycle.
Yeah, you'd have a lot of, looking towards that. But again, with that, David, what we'd say is you have to get out your crystal ball. You have to look into your crystal ball and you have to see where is the rate curve ending. So if the economists that are there are thinking the rate curve is ending in 12 months' time, you now need to try and fast forward and say, okay, how long will that rate curve be on the upward trend? And when will it be on the next downward trend? So, for example, what we seem to be guiding people at the moment is that if you were to fix short term, there's a very good chance that you'll be coming out in an upward trend.
Yeah.
So, there was a period that we were telling people fix for, 1, 2, 3 years. We're now probably in the period telling people to fix for 3, 4, 5 years. But again, it's down to individual circumstances. What is your attitude to financial risk? What is your attitude to, I'm happy to take a fixed rate longer term on the basis that I know my monthly household budget is not going to be affected by rates going up or rates going down. There are a lot of people there like safety in that. And if you are one of those type of people, we'd absolutely recommend that you fix long term.
Perfect. So we've spoken about rates. Let's speak about lenders. Okay. So we have the main pillar banks, the AIB, BOI, PTSB. They've always kind of been there. We've had some banks exit the market, Ulster and KBC recently enough. We've had a lot of newer entrants entering, likes of yours at MoCo or MUCO and Newer Money and Finance Ireland and stuff like that.
Okay, well, currently the market has 8 lenders in it. One of them is ceasing very shortly, which is Finance Ireland. They will not be providing mortgage services any further. So that will leave the market with 7 players in it. Those 7 players are, in no particular order, AIB Group, which encompasses Haven Mortgages and EBS, Bank of Ireland, PTSB, Avant Money, ICS Mortgages, MoCo, and Newer Money. Now, I suppose our take on that, David, is that we all know the Bank of Ireland and the ABs and what they do and what they don't do. We all know Avant as being the innovative lender that's coming out with the innovative products. Recently launched what they're trying to stay away from terming a tracker mortgage, but they did launch a flexible variable mortgage, which is a mortgage that is tracking the Euribor rate. The Euribor being the rate that banks lend to banks across the Eurozone. So you see there's innovation coming from Avant all the time. That is looking like, after the first month of it, is looking like a very attractive rate of just over 3%. Just over 3% being 3.0 something percent. So if you're taking that product today and based on last month's Euribor average, if you were under 80% funding with a 0.9 margin, which is their product offering, you would be on a rate of 3.04. Now, if you were to look at the others, that the more lesser known of the lenders that are there, ICS Mortgages, stands for Irish Civil Service. They're an old building society. They're around longer than most Bank of Ireland's or ABs are around, but they're still there, right? And Newer Money, who would be the newest of the lenders entering the market, and MoCo, who entered the market probably in the last 18 months to 2 years. They all provide a home for somebody, and they all provide a certain market segment that not every bank provides.
Yeah.
So if you were to look at the main lenders that are there, in a sense, they can cherry pick the type of business that they want. And for the likes of the MoCos and the NUAs to compete with these guys, knowing that they can't compete on rate offering, they generally have to compete on credit policy or product. And again, that's where they do fit in, and that's why they do have a home in the market. And the more in the market, the better. Right, you'd have a scenario where, trying to compete with Bank of Ireland on rates, these guys just can't compete on rates because they can't access that money in the money market at that level of rates. Bank of Ireland, AIB, PTSB are generally lending from their deposit book. So Mrs. Murphy goes in and lodges 10,000, they pay Mrs. Murphy €2 for it, and they lend it to David Looney at €5. Very simple, basic banking, right? But when you're going to the money market, you're borrowing the money that you need to lend at a certain level, and if you're to look at an average bank margin that a bank should be looking to make a profit on, it's somewhere around the 1.75 mark. So if you're going to the money market at 3%, you can't lend at 3%.
Yeah, fair enough. Yeah, well, this is important. So I suppose now that we're at a point where we've 7 different lenders, loads of different rates, loads of different options for different people in different situations, it doesn't really make sense for people to walk into their old pillar bank that they've always dealt with, because not only, I suppose, is it not making sure that they're getting the full market offering, but they mightn't be getting the best rate, they mightn't be getting the most appropriate offer for them. The only way that people are going to make sure that they're getting the most appropriate offer and the best mortgage for them really is by dealing with an independent mortgage broker such as yourself, Shane.
We'd be biased and we would tell you yes is the answer to that question. We'd also be big enough to say to you that, look, that we deal with an awful lot of inquiries on a weekly or a monthly basis where we still tell people we think we're comfortable with you where you are. I say, take your point, everybody should get independent financial advice, because not getting the right independent financial advice can be a very costly business. So if you walk into the bank and you just take the bank offering, Bank A is not going to tell you that if you went to Bank B, the rate was 1% lower. And there is that range of disparity between rates as well in the marketplace at the moment. So like, if you're to look at what gives you good rates in the market at the moment, the size of your mortgage is important. Is it under or over 250 as a general rule of thumb? Better rate for over 250 than for under 250. What's the loan to value in your property? Again, general rule of thumb, under 80% funding, over 80% funding, one gets a lower rate than the other. And the big one, and the big topical one for the last couple of years, is what's the BER rate in your property? So if you're to look across the market at the moment, you have Bank of Ireland offering a green rate of product for an A, B, C, D, E, F and G BER, where their lowest rate offering is 3.45. You have PTSB and AIB offering A and B BERs. Therefore, if you have a C or worse BER, you're looking at rates of 4.05 to 4.45 across that market. So here's where it's important, and you may have taken your mortgage 10 years ago, you may have taken a 5-year fixed. That 5-year fixed may have been extended for another 5-year fixed. And when you did that, BER rates were not a thing in mortgage land. So obviously I would encourage people to say that if you have a fixed rate, that's maturing in the next couple of years, regardless whether you have a new property or an older property, you should always research and say, okay, what's the BER rating, and can I get a green rate of mortgage on the strength of the BER rating of my property? It will save you significant money, and that's where the market rates are leading at the moment, is that I have a BER rated property.
Yeah, because there's a massive difference between the green rates, isn't there? And
there's a
the
huge difference
rates,
there, and it's a huge difference every month. And if you accumulate that over 12 months and you can accumulate that over the term of your mortgage, there's a significant difference going on.
And the green rate chain, is that a BR rating of B3 or higher, or does it differ from lender to lender?
It's lender to lender, but what you do have is you have the old rule of thumb was it an A or a B? A B being B1, B2, B3, right? Subsequently, Bank of Ireland, as mentioned, came out with a C, a D, an E, an F, and a G in offering.
Okay.
Then on the flip side of that, you have Avant Money not interested in the BER rating. You have MoCo not interested in the BER rating, and you have other lenders who take that stance on it. So, but really, if you're looking for the top end rates, you're looking for an A or a B BER. But if you have a C, D, E, F, G BER, you need to be saying, okay, I need to research myself here and say, okay, am I with the right lender for my level of BER?
Yeah. So we spoke about new entrants, and we're all aware, obviously, of the shift to more kind of fintech banking solutions for maybe like deposits, current accounts, credit cards, and something that's grabbing the headlines in the last couple of weeks is Revolut announcing that they might possibly be entering the Irish mortgage market. Do you see that as kind of shaking things up? Or, I mean, I presume it's not going to be as easy as them literally just getting, I suppose, accessing it through your Revolut app. Like, I presume that they have to get like regulated in Ireland. There's a lot of kind of legals and compliance and stuff like that here in the market. It's not as easy as placing money on deposit with a bank in Germany, let's say, through a smartphone, is it?
I don't think so, and we're very uncertain about how all that's going to pan out, particularly Revolut. Okay, if you try and deal with the question is, okay, they need to get regulated or they need to get passported into Ireland. The licence they recently got, which drove all the news, was a UK banking licence or lending licence that can be passported into other countries. Getting passported is as good as being regulated in the country in your own right, the level of detail that they have to go into. But again, go back to something that happened, I think in 2016 it was a mortgage credit directive that came from the EU. That credit directive was very much around cross-border transactions, typically meaning that a German bank could lend to an Irish customer or vice versa. We have yet to see it.
Yeah.
Right. I think, but a number of factors behind that. Number one, the size of the Irish market. The size of the Irish market is typically the size of the Manchester market.
Oh.
So if you're a bank looking to come into Ireland, you're saying I can play with Manchester or I can play with Ireland, I know what I'd be playing with. You also have that we are a very laborious process still, mortgage application, mortgage approval wise. Anybody who's looking at your podcast and saying, okay, I made a recent mortgage application, they'll know the drama they have to go to. So when you look at fintech and you say, okay, how is fintech going to take away all that drama? And that's the bit that we are very uncertain of. Yes, there are lenders that are more, fintech based than based on pure paper format. So, for example, Moco and Nua would be leading the way with their systems versus the more laborious systems that you'd have of a paper-based system.
Yeah.
So I suppose the big new one for us was that Nua Money offer an open banking facility. So if you sign up to an open banking facility, they can access your bank accounts. So you're not having the scenario where, oh, can we have 6 months of this and 2 months of that? And by the way, what's that transaction? What's the other transaction? So they're the first to really start that.
Yeah,
so
because we have
all
seen
these
that.
little additions. Yeah.
We have seen that with kind of like personal loans and credit cards through some of the fin banking stuff where you kind of links your bank accounts not within that institution,
Correct.
isn't it?
Yeah.
Okay.
Correct. And again, go back to Revolut. I think Revolut are building up in some shape or form to be a player in the Irish market. How much of a player depends on how much of an effort they put in and how successful they are in how they put their product out there. Typically, if we're looking at, Revolut current accounts, we're looking at Revolut savings, their modus operandi was always we'll significantly undercut, right, the local players. They come to the market here and undercut it again. It's going to be, okay, where's their money coming from? Where are they funding from?
Yeah.
Are they funding from money markets? Are they funding from a deposit base? How much of a deposit base can they fund from? And that's going to dictate what their rate is. And I suppose other things for, Revolut to consider, or for people to consider here, is that they will come with some form of a proposition or a process proposition that will appeal to people, particularly the younger people it'll appeal to. And if it's appealing to those younger people, they need to be sure that the system that they're having is safeguarded, that they have their systems properly in place that safeguards the information for the client. And that's one of the things that, you'd read a lot about Revolut, that it's an area they need to focus on and tidy up themselves.
Perfect. Well, look, Shane, that was really insightful, really interesting. Definitely some great advice there for prospective buyers, existing mortgage holders. Great to get a good sense of where the market is and what the future might look like for the Irish mortgage market. But just before we finish up, for anyone who's interested, how can you guys be contacted?
We can be contacted at Munster Mortgage and Finance. We're a Cork-based office, South Mall in Cork. No problem at all with somebody ringing in or even hitting us on the website.
Fantastic. Thanks so much for your time, Shane. Look, we'll definitely try have you on again at some point in the future.
No problem at all. You're more than welcome.